Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Molly, a lot of movement here in the commodities. Gold off big. Bitcoin ripping.
Absolutely ripping.
So who do we talk to?
82,000?
Yes. So who do we talk to? We talked to Mike McGlone. Miami Mike, senior commodity strategist for Bloomberg Intelligence, safely ensconced in Miami. He was doing Miami before it was really chic. He was down there early. Mike, talk to us first about Bitcoin. We're pushing up against $83,000 per token. What's happening here?
The world changed last Tuesday, and it's almost a perfect storm for Bitcoin. So think of all the anti-Bitcoin regulation and pushback from the previous administration and Gary Gensler. That's completely flipped. It's delightful to see for some of us who wrote about this 5 years ago that any U.S. representative or regulator that did not understand that the base layer of this place was actually organically went for the dollar. Most widely traded Bitcoin crypto is not Bitcoin, it's actually Tether, the dollar token. It's delightful to see them figuring it out, what's really happening in this space. So it's nothing but good for Bitcoin. The market's getting frothy, but it had a good period of 6 months, which just hung out. Now it's just taking off, and you're seeing massive inflows in ETFs. People can get exposed to it. And it's kind of kicking into that old mantra. Is it digital gold or is it leveraged stock market? Right now, it's stock market's making new high. Bitcoin's making new high. And Bitcoin's back to that leadership role.
Mike, tell me how much of this trade right now is dependent on Gary Gensler not being in the SEC. And can Trump honestly do that?
Oh, sure. Well, he's going to be gone within months. Right? It's just a question of when. He's a very unfavorable SEC chairman. He made a lot of enemies on both sides of the aisle. But this is just part of what got him elected. And it's the key thing I think the market's figuring out is let's not underestimate this emboldened next president. He has been reelected by completely decisive election. And his mantra, everything he said in his campaign, I'd say be careful to disagree with. For instance, I'm reading the latest book for Robert Lighthizer, who was his past trade representative. And it's called No Trade is Free. And we should expect him to do what he says, partly because he has carte blanche, at least to the midterms. And there's still a pretty significant trade deficit. So from a commodity standpoint, it's very bearish. From a Bitcoin standpoint, it's very bullish, partly because he tilted over and he got the Bitcoin people on his side. I don't think he wants to upset them.
Mike, I can't even remember the last time we talked about valuation and how you're supposed to value Bitcoin. Just refresh our memory on how you think about that whole concept.
Yeah, well, technical analysis. So, I mean, I like to compare it versus gold. Right now, I'm looking at it. It's, as some hedge fund managers call it, the fastest horse in the race. I mean, versus all risk assets. The risk right now is Bitcoin's making new record highs, but its correlation, 60-day correlation to this S&P 500 at 0.7 or so, is the highest ever on the way up. So it's a leading risk asset. It's priced for all this optimism about U.S., the Trump election, but markets are so expensive already versus when he was elected in 2016. They were very low. Certainly Bitcoin was. So there's so many ways, but stocks to use is one way they do it. The key thing that I like to say is there's definable diminishing supply, and you can see that by just the code, and there's increasing demand and adoption. So over time, the price must go up. And right now it had a major flip that the unexpected election of Mr. Trump has just flipped it over to the bullish spirits at the moment.
Now, this is something I was really surprised to read in one of our stories, that Bitcoin now ranks only second to the fossil fuel industry, or rather the crypto industry at large, in total money deployed since the 2010 Supreme Court decision that limited funds on campaign political spending. That's shocking. Anyone else to think that crypto is number 2 to fossil fuels? Like, where is all this, campaign influence money coming from, Mike? Who are the big spenders here?
So, well, I don't know exactly who they are. I mean, last time we heard from the Biden administration, Sam Bankman-Fried was the number 2 donator. That didn't work out so well. That's why partly the Biden administration pushed back after the collapse of FTX. The bottom line is, let's look at in ETPs now, ETFs. Bitcoin's about 92 billion. Total gold ETPs are about 230 billion. So it's catching up fast. And remember, this Bitcoin's only been trading in exchange-traded funds for a few years. Gold's been almost 20 years in exchange traded funds. So it's just the the digital gold is taking on the old analog gold, and the question of where it stops. The way I see it right now is, yes, everything looks so bullish. It's just a little bit expensive. But I published today, is Bitcoin digital gold or is it leverage bait? And right now, it's much more leverage version of the stock market, and animal spirits are in full force.
You mentioned gold. Mike, gold is down about 2.3% today. What's the trade here in gold? Is this just taking some money off the table after a big run?
Potential lessening of geopolitical risks, the definitive election of Donald Trump. Gold was way overdue for a correction. We're already hearing of inklings of Mr. Putin and Mr. Trump talking this last weekend. And if there's any detente coming in the world, that's going to be a major pressure factor for gold. But in the meantime, gold on the 1-year basis is still up about the same as S&P 500, around 35%. It's way overdue for a correction. I'm looking at 2,500 as good support levels it could come back to. It just got way too expensive. So at its peak, I think that was early October. It was up 39% in the year. That would have been the best year since 1979. So it's a bull market pulling back. But then looking forward, if there's a major shift in what's happening in China, I mean, Mr. Z kind of tilting away from President Putin, maybe towards the U.S., that's bad for gold. But overall, it's the key thing is there's still some major geopolitical factors supporting gold. And the bottom line, like I say, for gold is gold will be gold's major catalyst, I think, to go higher is at some point when we see the next bear market in U.S. stock market. Maybe God help us if that ever happens again.
All right, Mike, thanks so much for joining us. As always, Mike McGlone, he's a senior commodity strategist for Bloomberg Intelligence, BI Go. Go check out all his research on all commodities. He covers everything from the softs, the grains, to the metals, to the all kinds of stuff, including Bitcoin. So he kind of has it all covered there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Kim Forrest joins us, founder and chief investment officer at Bokeh Capital Partners, on Zoom from Pittsburgh, one of my favorite towns. So, Kim, you woke up with your team on Wednesday last week. What changed for you guys, if anything, in your outlook for markets?
If anything.
If anything.
If anything, yeah. Well, really nothing, because our view is the long term. We believe strongly that if you have money in the market, it should be in there for a minimum of 3 to 5 years. You can think about harvesting what we do today in 3 to 5 years. So that kind of time heals a lot of wounds, we'll just say, and makes things better in the long run. And you just have to work with what you have. So that's what we're doing. And actually nothing changed, because we were believers in having that barbell strategy of large cap and small cap together. Small cap has been suffering for a myriad of reasons. And we're looking at, and by small cap, I mean companies that have $1 billion or more in market cap. The micro caps we're not at all interested in. So we think that the large caps have had a great run over the last couple of years, and it looks like maybe small cap will have its moment in the sun coming up in the next couple of years.
So are you saying, Kim, that you're not really buying into the Trump trade? You're not out there, buying a ton of Bitcoin and selling treasuries right now?
I'm sorry, I couldn't even let you get that out. Buying a lot of Bitcoin. Well, paint me as old-fashioned. While I think Bitcoin is interesting to watch, I don't really know how to value it. I heard your guest on the prior segment also kind of reflecting that. And my big thing whenever I talk to investors that we serve about Bitcoin is, whenever you can pay your taxes with it, I'll pay attention to it then, because that means it's a real currency. Right now, it is not a real currency.
So, Kim, when you look at the small caps, boy, you've got to have a good call on management, because they have such an outsized influence on kind of how the business develops. How do you do that with some of these smaller cap companies?
Sure. Well, first thing, we have time on our side, because I've been doing this for 24 years. And I started on the sell side, where my director of research encouraged me to have half small cap, half large cap. So I'm kind of in the groove on this. But what I do is I look for several markers. First of all, growth is always important. I am not strictly a growth manager. I'm growth at a reasonable price, but growth has to be there. And how do you get growth? Well, you sell more product. And how do you do that? Product marketing. It sounds really boring, but what it really is having a process to understand your client or customer, and then having a repeatable process where you make your product and service delight your customer and they come back over and over and over again. And can it really be that easy? Yes, it is. It's hard to spot and you have to do a lot of fundamental research, but that's what we're doing, is looking for that kind of perpetual money machine where businesses know what clients they serve and every day get up and try to serve them the best they can.
So it looks like you've got, with earnings season still going on, we've got the retailers coming up next. Just tell me about your view right now of the U.S. consumer, the economy at large. There's been all these calls for a slowdown, and it just hasn't really been all that noticeable yet. And so just wondering when you really think that tipping point's going to happen.
Sure. Well, I kind of have an unusual view of the economy. I think there's a lot of slowness out there if you go out and look for it. Pretty much in people who are in the lower 2/3 of the economic food chain, we'll just call it. There's a lot of stress. If you walk around stores like Walmart, you hear a lot of discussions about what we can and can't buy as a family. And I think that had a lot of influence on the election, right? But more importantly, I'm not one of the people that are necessarily looking for the next recession either. I think we have these slowdowns now. And why do I think that? Well, companies have software in place like CRM, Salesforce, to be able to understand what their pipeline is. And then they have ERP or exotic or very fancy accounting systems that let them match the supply and demand. So we have seen over the past 20 years, very few or no recessions that were caused by too much capacity, right? Companies are really good about being able to tailor that to the conditions. But we do have crisis, and nobody can really predict crises very well, or at least the timing of them. Right. They may see them coming. So that's what I think the economy does now.
Right. All right, Kim, thanks so much for joining us. Really appreciate it. As always, Kim Forrest, she's a founder and chief investment officer, Bokeh Capital Partners from Pittsburgh, PA, one of my favorite towns.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Today, Cigna Group said it won't pursue a combination with rival insurer Humana after reports the two companies had renewed discussions. Cigna shares jumped by 8.7 at the New York market open, while shares in Humana dropped by 6%. So not so much here for this particular deal. Glen Losev joins us. He's a senior equity analyst covering the healthcare services space for Bloomberg Intelligence. He joins us here in our New York Bloomberg Interactive Broker studio in New York. So, Glenn, talk to us about this deal that did not happen between Cigna and Humana.
Yes, so this is the second try, if it wasn't the rumor. The first time the companies tried to merge at the end of last year. It also didn't take long to fall apart. This was the second time, and we don't exactly know what happened, but my view was that the takeout price for Humana, the companies will not agree upon, and that's probably the reason. Over the last 11 months, Humana lost half of its market cap. It's very difficult. Obviously, Cigna is a much better place to pitch the merger, but also when you were trading at twice the market cap just a few months ago,
right.
It's difficult to agree on price.
And they couldn't really adjust that at this stage, with Humana stock now having dropped so much in the meantime.
That's what I'm thinking. It wasn't confirmed. The only thing that Cigna said that they're not pursuing the merger, but price is probably the reason for it, the agreement on the price.
All right, so Cigna is an insurance company.
Yes.
Humana is a healthcare services provider?
No. So Cigna and Humana are both health insurance companies.
Both health insurance.
Cigna has a huge pharmaceutical benefit manager, Express Script. If you remember, they acquired it a few years ago. It's one of the top three. Humana and also Cigna focuses more on the commercial business, which is employer-based insurance, while Humana is focusing on Medicare, people who are over 65.
Got it. And you got to think now, like Cigna's stock up a good bit today. They've done a lot of share buybacks. Would think that that's going to be now the strategy going forward. Coming back to those again.
Yeah.
What else do you do when you're not about to spend a couple $2 billion on another company?
You basically
probably feel a lot richer.
Yeah, but you basically they're expanding their expanding their pharmacy business, part of the Express Script. That's where the tailwinds are over the next few years, and just stugging along, trying to, cut costs and improve revenue. That's basically the business model.
All right, so healthcare investors, they woke up Wednesday morning last week. What did the election mean for the healthcare space?
So for healthcare space, it's very broad, but for example, for health insurers, basically, it's Trump's win is positive for Medicare Advantage companies, rule of thumb, sort of like Humana. And there's an overhang for Medicaid insurance companies like Centene and Molina because of the work requirements, possibilities, and also Obamacare subsidies expiring at the end of the 2024.
His presidency is also obviously positive for M&A. Any chance that this deal gets revisited again, or Cigna maybe has another target?
There is always a chance for this deal to be revisited again.
We got to give Paul a chance to live out his dream here of being a healthcare M&A banker.
Exactly.
Right. Overall, managed care industry is facing headwinds. Costs are going up. Government debt is through the roof, so they're not going to get paid as much as they did 5 years ago. So it's a margin contraction possibility. So, buying another health insurance company is always a benefit. Because for insurance business, any insurance business, scale is the king for any type of insurance business. So there's certainly a possibility that they will revisit and maybe agree on the price this time.
All right, Glen Losev, thank you so much for joining us. Glen Losev, he's a senior equity analyst covering the healthcare services businesses for Bloomberg Intelligence. You can get his research by going BIGO on the terminal. And then you can scroll down to the healthcare stuff, and we got it all covered on a global scale. So we appreciate getting a few minutes of his time. A deal, I guess, not happening in the healthcare space.
Oh, so you'll have to look for another one.
Yeah, exactly. But again, it just seems like if a lot of these big pharma companies, if they can't come up with whatever they need to come up with through their R&D, they just go out and buy it.
Just go out and buy it. Yeah, if it's not organic, you know.
Exactly right.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, Molly Smith sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. So go over there and check us out. You can search Bloomberg Podcast, and that's where you will find us. A lot of questions being asked by market participants about some of the policies that we may see coming out of President-elect Trump's second stint in the White House. David Young joins us. He's the president of the Public Policy Center at the Conference Board. David, thanks so much for joining us here. What are the key areas you're looking for or looking at with a Republican in the White House, a Republican Senate, and potentially a Republican House? How do you think we'll see policy ramifications stem from that?
Yeah, well, good morning, and thank you again for having me on. I found the conversation before very interesting, and also just a side note, as a former Division I tennis player, I unfortunately was not 6'1" to 6'3".
Oh no!
That profession was short-lived, but yeah, when we're looking at top kind of the initial priorities from a Trump 2.0 administration. I think the one that is talked about most, and you guys were talking about it earlier, is tariffs. Obviously, you guys mentioned this. There's this 10 plus, so 10 to 20% universal tariff that Trump has talked about, but then also the 60% tariff on China. I think it's also important to just mention when we talk about tariffs here, there is also a direct correlation towards trade. And when we start talking about trade, we start talking about trade agreements. So upcoming next year will be the renewal, should any of the three countries, Canada, the US, or Mexico, require it, a renewal or refresh of the USMCA, which I think will have some pretty significant ramifications, especially given the role and relationship between Mexico and Canada. I describe Mexico increasingly as one of those connector economies. So goods come from China through Mexico, then up through the US. So it'll be really interesting to see what Trump does with regards to that trade agreement and how he leverages tariffs. Beyond tariffs, a couple other areas to mention, climate and what he does with Biden era regulation with regards to climate, but also beyond just what Biden did, international trade agreements. So Trump has said that in his initial days in office, taking a much closer look at the Paris Agreement and potentially leaving that agreement. In addition to tariffs and climate, obviously the regulatory environment and regulation reform, industrial policy and electric vehicles. I know you guys were talking earlier about Tesla. Trump has said that he would repeal Biden's electric vehicle mandate. And also there have been conversations around the value of the CHIPS Act versus the role and impact of tariffs. Finally, the tax bill and what that means in the year ahead. And those are some of the domestic issues, I think, from a foreign policy standpoint. The two that initially jump out, obviously, Russia and Ukraine, and also Israel, Gaza, Lebanon, the future role of Iran, and what Trump decides to do with regards to those two issues. I'm not forgetting China and Taiwan. I just have left that one to the third position because the other two kind of have dominated over the last 12 months. But with regards to China and Taiwan, it is clear of China's intentions. And so you can only anticipate that issue area from a foreign policy standpoint gaining more and more traction in the years ahead.
Thanks, David. That was a very comprehensive look at what we're going to expect. Something that in my other day job here at Bloomberg, I cover the U.S. economy, and we take a look at that confidence index that your firm puts out every month, and we're going to get the latest look at that a little bit later this month for the November reading. Just tell me a little bit about what your expectations are ahead of that. We know it's an index that tends to be a bit more tilted toward consumer views of the job market, but curious to think, especially based on the reactions from the exit polls and how consumers were or voters rather, were very concerned with the economy, how you think that the election results might be reflected in the next reading.
Yeah, so it is interesting. And if you look at confidence, it's definitely moving. The trend is moving in the right direction. But it's interesting when you look at the right direction and things improving, did that actually relate to how voters voted on the day? And there's definitely a degree of disconnect. And I think from Harris's perspective, she was unable to convince voters that recent improvements in the economy, including the decline in the headline inflation, stronger than expected growth, have made a difference in them. In kind of voters' lives. So number one, there is a disconnect. And I think there is also certainly a lag when you start looking at what people believe, how they feel, and how they actually went out on that day and voted. I think that also connects and is shown to, if it is not the top issue area that affected how people voted, it is one of the top two issues, which is just economic growth. And the economy in terms of how that's playing out on a daily basis.
David, thank you so much for joining us. David Young, he's the president of Public Policy Center at the Conference Board, joining us via Zoom from Atlanta here. So we'll have to see, again, the early days of President-elect Donald Trump. His administration, like any administration, his first 100 days are key to really get things done. Yeah. So we'll see how aggressive Mr. Trump's administration will be coming out of the gate there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube. So go over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. All right, here's the mistake I make when thinking about commercial real estate. I just think offices. But it's so much more than that, which I keep getting schooled on.
You'd have broadened your horizons.
I knew. Multifamily housing, student housing, warehouses, all that kind of stuff. Our next guest can kind of help me out here. Jeff Brown, founder and CEO of T2 Capital Management, joining us from Chicago via that Zoom thing. Hey, Jeff, talk to us about where you guys at T2 tend to traffic in commercial real estate. What's your area of expertise?
Sure. For starters, Paul, I appreciate your delineating office from the broader commercial real estate market. A lot of people do jump into that pool. Yeah, at T2, we are very focused on the student housing space, on the multifamily space, and we also run a private credit fund as well.
You know, I find the student housing story so fascinating because this is like, you know, we talk about in the U.S. economy, this structural shortage of housing, like, you know, just for like everyday people, single family homes. But it's really like in some places no more evident than on a college campus. There's been so many stories about, you know, at UCLA, like kids renting out, you know, RVs and like really renting out a private person's driveway to put the RV. So because they can't find a place to live. And where I went to school, Syracuse, a hotel that was in the middle of campus is now fully a dorm, and another apartment building bought back to be a dorm. Anyways, all that to say, where are all these students living and where are the opportunities for you guys to come in and help?
Yeah, those are great anecdotes, Molly, that are still pervasive today. So for us in the student housing space, we're active at schools like Purdue, Auburn University down in Alabama, University of Tennessee, Georgia Tech. So we tend to migrate toward where there's really explosive enrollment growth, where there's a STEM focus, just a high demand for students to be there. Ironically, some of the anecdotes you just shared about students being forced to live in hotels or just these makeshift apartments on campus because of the lack of supply. That has been our story at University of Tennessee as well as Purdue. So we're benefactors of those as landlords, but hate to see it, frankly, for the students and those parents.
You know, in my freshman year at the University of Richmond, it was a trailer.
Where you lived?
Yes.
Was there not a dorm?
There was not a dorm. It was a trailer. My dad pulls up to unload me. He's like, "You got to be kidding me for the money I'm
spending." Turn around.
We had a heck of a good time in those trailers. I'll tell you, we'll just leave it at that. The mods down at the University of Richmond. Hey, Jeff, if you want to go out and build some student housing or multifamily housing, where are you going to get the money? Are banks lending?
Yeah. Thankfully, I would say banks are lending. It's certainly much more conservative than probably historical standards. Interestingly, banks, I find them uniquely healthy right now. I think so many learned their lessons from the 2008 global financial crisis and have ratcheted back advance levels. So they just have some decreased exposure. So maybe historically they would have been at 65 or 70% of cost or value on a project. I think today it's pretty customary to be at 55 or 60% advance rates. So a lot of buffer for them and margin for error. So I would say banks are actively lending there. The hard part, frankly, and I think I heard your prior guest even touch on this, the hard part is finding the equity. So if banks are at 55 or 60%, where are you getting that other 40 or 45% of the capital stack necessary to take on a project? And so that's been a bit of a Rubik's Cube, frankly, for the past couple of years as interest rates have spiked and capital has retreated to the sidelines.
What do you do when you're looking, though, at such a constrained labor supply right now in construction, and especially with the prospect of this new administration really, rolling back a lot of the immigrant workforce? Is that concerning to you about how much more building can really happen in the next 4 years?
It is, and I'll tell you, going back to the student housing aspect of our business, we have bought far more existing student housing and did some cosmetic changes to properties than we have done ground up development, simply because those construction costs they really spiked during COVID and caught a lot of attention for supply chain issues, shortage of labor, and other variables. Unfortunately, the cost of construction hasn't plausibly come down to where it's still viable to build ground up construction. Certainly, some folks can get away with it. They'll take on lower margin projects, thinking that maybe down the road the margins will make some sense. But it's been very, very tricky to make numbers work in the ground up construction, whether it's student, multi, or any other asset class.
How about, we talk about student housing. How about senior housing? I mean, all we hear about is how this population is aging and there's going to need to be for more and more senior communities. How do you guys think about that business? Have you looked at that?
We've looked at it, we've participated in it, and we've just paused on it, frankly. It's a very operationally intensive business where you're so dependent on, like I said, it's a running business. So you have your operator who's handling all the day-to-day activities. Oftentimes there can be a bit of a misalignment between operations and ownership of the property. We try to stay away from those situations and just stick to what we know best, which is student and multi.
I got to ask you, though, something that I wonder when I see all of these universities that are like busting at the seams with students and nowhere to put them. Are enrollment rates that much higher, or acceptance rates rather, that much higher? Because right now the sentiment about getting a college education has really never been worse. So I just wonder, are the universities just letting in that many more kids?
A great question, Molly. And I'd say, just like Paul did to start off this segment, office doesn't define how the commercial real estate market is doing. I think you really got to be careful with which student housing markets, which campuses you're at, before you say a broad brush statement about student housing as a whole. There are some schools that are seeing record applications and having the choice to make do we want to go with a record enrollment as well? And they got to be mindful of how much supply, how much infrastructure, let alone classrooms and other space available on campus do they have to accommodate the student population. So it's very school specific from my perspective, and that's where I think Tennessee and Purdue, schools that we're very close to, have done a fantastic job at managing that and drawing demand at the schools.
Right.
Others need to be careful and make sure they're not reenacting your experience, Paul, and students are rolling up to a trailer once they show up on campus.
Yep, the mods, as we call them. Jeff Brown, founder and CEO of T2 Capital Management. Thanks so much for joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Molly Smith sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we are streaming live on YouTube. So head over to youtube.com, search Bloomberg Podcast. Every industry, I think everybody out there is trying to figure out, what does the second Trump administration mean for my company, my industry? And that's certainly true of the energy space. And my guess would be drill, baby, drill.
You took the words out of my mouth.
There you go.
Yeah.
Let's talk to somebody who really thinks about this and knows what he's talking about. Tai Liu, Oil Market Specialist for BNEF, joining us here in our Bloomberg Interactive Broker Studio. So, Tai, I would think that a second Trump administration would be good for the energy space. Is that a fair assumption? How do you guys think about it?
Yeah, hi Paul. Thank you for having me. Yeah, definitely. I think the U.S. oil industry and the gas industry can benefit from a Trump administration in a number of ways. I think the first off the bat is like lower corporate tax rate. So President-elect Trump has indicated he would like to lower corporate tax rates from the current 21% to 15%. So if that materializes, that's right off the bat, that's like more money for the industry and for the shareholders.
What are they going to do with that money then? Are you suggesting it would be share buybacks or what?
Yeah, so there's definitely like a number of options these companies can do with this quote unquote extra money. They can, like you said, they can do more buyback for the shares. They can issue more dividend payouts. They can reduce the debt, and finally, they always have the option to funnel some of these money into capital expenditures, which ultimately translates into more production down the road.
How about from the regulatory standpoint? I mean, can I go down there now and drill a well? Can I make a pipeline to take my natural gas to Corpus Christi or wherever it needs to get to? Is it going to be easier under a second Trump administration to build energy stuff?
Yeah, I would definitely think so. So under the Biden administration, the government has imposed a lot of regulations that are deemed as unfriendly to the oil and gas industry. The government issued a drilling rights moratorium. They placed a pause on energy exports permits, and they also increased royalties on federal land leases. And I would presume, and all of these were pretty hostile and created a lot of uncertainty to the industry. So I would think that Trump administration would remove a lot of these regulations that are deemed as onerous to oil and gas producers. So definitely beneficial from that point of view.
You mentioned before, increasing CapEx potentially and how that would mean more production. Got to though worry about prices. If you are producing so much more, what happens to the supply-demand equation there? Is that already something that drillers are thinking about, of how much more they might want to maybe not go in too much?
Yeah, that's for sure. So if you look at the past 10 years, U.S. oil producers have, on several occasions, crashed the oil prices when they decided to turn on the production taps. So they're very cognizant of the risk this time around. On top of that, there's a lot of shareholder pressures on these oil and gas companies to maintain capital discipline and to increase capital payback. So from that sense, I think even though if there's more money to go around in the industry, it would be much harder for the U.S. oil producers to grow production the way they did in the past 10 years or so.
When did the U.S. become a net exporter, like 2016 or something like that?
Yeah, I think so.
Okay, so we were a net importer forever. Then we became, thanks to the shale finds, we became a net exporter. How does the U.S. oil industry, I'm not sure if you can even characterize it, or is it just individual companies, how does the U.S. oil industry interact with OPEC, if at all?
Yeah. So the way I think about it, they're very competitive, like natural competitors against each other. So if lower taxes in the Trump administration materializes, it would definitely make the U.S. oil patch a lot more competitive. It would also lower the break-even calculations. There would be more money to go around. So it will make it much harder for OPEC to increase their output. So it's going to place OPEC on a more difficult ground.
Something that in part got Donald Trump reelected to the White House was the idea of bringing prices down. And, gas prices, obviously a big sticking point for a lot of Americans. Gas prices have been coming down pretty consistently over the past, 6 months or so, down to now about roughly $3 a gallon on average nationwide. What can Trump really do for gas prices?
Well, when I think about gas prices, there are two pieces to it. There's the crude oil price part, and then there's the refinery margin part. Now, on the refinery margin, there's probably not much a president can do to it, because you basically have to increase refining capacity, and that takes years to build out if you want to play with that part. The other part would be the oil price part. Now, if you reduce regulations, make it easier for companies to drill, you can theoretically, you can prevent some of the possible price spikes in oil prices, just because it's less onerous for these drillers to put more capital into the ground. So in that sense, you can help prices from seeing more spikes. But however, I don't think these companies will really go all out and drill again the way they did before, for the reasons we talked about before.
So what's happened to the Russian oil? It's been a couple of years now. Mm-hmm. And if it's not going to Germany, where's it going?
Yeah, so it's not going to the Western European nations and Western nations has placed sanctions on Russian oil. So a lot of that has been brought up by countries like India and China. So they're really benefiting from these sanctions.
So these sanctions aren't really working, are they?
They're redirecting trade flow.
They're redirecting trade flow.
And they're making it harder for Russia to ship their oils around the world, so it does increase the cost on the Russian oil producers. So that's an impact, but the impact I feel like is probably more limited.
We do import some oil, though, right? It's not all domestically produced. Mm-hmm. I mean, is that subject to tariffs?
Well, I think this morning Trump has indicated he will accept. Well, we do accept import a lot of oil from Canada, just because of the crude rate that we need in the Gulf Coast. It's more fitting for Canadian heavier crude oils. And I think this morning he did mention that he's going to exempt some of these crude oil and natural gas imports from Canada, so he can really do it in a very surgical ways, even though if he does impose tariffs.
All right, so I think the takeaway from this conversation is that oil companies are going to make more money through lower taxes.
Drill, baby, drill.
Tai Liu, thank you so much for joining us. Tai Liu, Oil Market Specialist at BNEF. I guess our friends down in Houston, Texas, they're happy about this.
Oh, I would think so, yeah. I mean, we did just have that big take the other day about oil and gas being the most productive U.S. industry. You got to think of what happens now? You're just going to ramp up the drills even more.
But as Tai was mentioning and other analysts have mentioned, these companies, they have financial discipline now. They don't just drill.
That's right.
They return cash to shareholders and bondholders, unlike past cycles where
I was going to say, the 2016 to 18 years. Yeah.
So they've, I guess they've learned their lesson and more helpful to their equity holders and their bondholders.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.